Hi, good afternoon. I'll be talking about some general terms and about the most important term sheets that exist for Series Seed. Afterwards, after this introduction, we'll be sharing a panel with Carmen and Padraig, where you can also ask your questions. Okay, so basically, the most commonly used ways of financing for Series Seed they're divided into convertible instruments, convertible financing instruments, and also equity financing. So convertible notes and convertible financing structures have become more and more popular because they require less effort and less time and expense to raise funds and to allow founders to focus on their core business, on their operations, and the more pressing activities. So first of all, the convertible note is a debt instrument that converts into equity when a defined event occurs, which can be another round of financing. We have the SAFE agreement. It is called the simple agreement for equity because it's very short. It has normally 5 pages, and it is intended to be extremely convenient. And this one, unlike the convertible note, has no debt features. It has no interest and no maturity. And this also allows for greater flexibility, so the founders don't have to worry about meeting that maturity and can extend their financing for a little bit longer. Also, the KISS, keep it simple and stupid security, is a list of open source documents accessible to anybody that wants to draft their own documents without having to go directly to a lawyer from the beginning, and they include all the necessary features of convertible financing structures. So it's intended to also be a convertible sort of a note financing. So typically these when the startups take a look at these deals at these financing options. It's at the moment when they want to raise around $150,000 to $1,500,000. This bracket is, of course, a little bit more flexible, but it's because larger amounts usually raised through equity financing that require more effort are seen a little bit later during A series and subsequent series A, B, C, D, and so forth. So the important things about convertible notes, there are many, but these are some important features that you need to take into consideration when negotiating. So the discount rate that typically sits around, this is again a big bracket, of 10 to 30%, is determined on the price per share of the standard preferred stock sold in the equity financing. The equity financing being the next round. The preferred stock is the type of instrument of share that normally founders convert, investors convert to. Also, the valuation cap is the maximum amount, the maximum company value at which the note will convert. This is an important, a very important item because, well, it's the value of the company. Then we have other items like the maturity date, which can come before the conversion event has occurred. So so we need to take a look at the possible outcomes of a maturity date arriving before the next round has occurred. Really, convergent events really are mostly automatic, and they can be another round of fundraising, an acquisition, or yeah, mostly those moments when there's another injection of capital. Interest rates typically range between 5 and 8%, and then there's an item called, well, this is linked to liquidation. Normally, if a company is acquired, or for this is normally the investor will get a premium besides their the investor might require a premium on top of their investment and the interests that they get. So as I said before, the SIV is not really a debt instrument, and it shows in the company's cap table. So this little table has a comparison between a safe and a convertible note, and normally the most, as you can see, the differences are there is no interest rate, and there's no maturity date. Also, the incorporation has to be a little different, because obviously, since it's not debt, then the incorporation. I mean, when there's a convertible note, then the being debt, then a limited company can exist, whereas when it's a safe, this cannot happen. So again, this sort of instrument allows the investors to convert it at a later round to preferred stock that has some certain rights that are greater than common stocks that are usually held by the founders or the employees. So there are different kinds of safes with a price cap and no discount, where the price cap is equal to the valuation cap. With discount and no price cap, so there's no minimum amount for conversion that has to be reached. With price cap and discount, and most favored nation, which means that if there are more favorable terms that are given to new investors, then the holder of the note will inherit those more favorable rights. And for KISS, there are two versions. There's a version for debt and a version for equity. And you can see like these different types of conversions. So in financing, well, yeah, the conversion into preferred stock is it's at a price that is lesser of the cap and the discount. In acquisition, the agreement turns into common stock at a valuation cap or a multiple of investment plus the interest. At maturity, it can turn into a preferred stock at a cap or demand repayment from the issuer. And usually, the investors require information that is given quarterly, or some sort of reporting to let the investors know how the company is running. Since private companies don't have any obligation to share a lot of data, they would have here an obligation to share a lot of information with the investors. And finally, participation rights, that we can talk a little bit during the panel a little bit more. Pro rata, basically allowing the investor to have the option to participate in the next round to maintain their current percentage of shares, and other participation rights that we can get into more detail during our discussion. So these are, well, this introduction has focused on convertible notes, although there's also the possibility to get financed with an equity round. But why is it so popular to get financed with convertible notes? So the pros, as I said before, is that they're simple. The structure it's fast. It's cheaper for founders, and it has fewer complications. So it allows the entrepreneurs to focus more on their company. Also, the valuation negotiations can be deferred to another round. Sometimes the investors and the founders cannot agree on a valuation because there are not enough metrics. So they can focus on the metrics for the next round to determine a fair price. Another pro can be considered the discount rate. It allows investors to convert the amount of their loan plus accrued interests. The investors are taking a risk when they invest in companies that don't have enough metrics yet. So it's a pro for them to be able to be compensated for the risk. And some cons would be that some investors prefer to wait until a priced round, even if they have to pay a higher price. So it'll be more difficult to find investors that are willing to take that risk and believe in the company without having necessarily all the metrics. And this con is also very related to the investors' feelings. So maybe they're scared of foregoing the rights of a shareholder, voting rights, all sort of rights like control and liquidation that they don't have when they sign a convertible note agreement. And another con can be a possible conflict in the objectives of if there's an uncapped convertible note, then the issuer will want the valuation to be as high as possible, while the note holder wants exactly the opposite. They want a very low valuation. So that sort of conflict could arise from this sort of financing. So, as I said before, the kits and the SAFE are meant to help founders build their material. They're open source, and they also explain the terms thoroughly. And so here are some useful links that you can visit, and you can take a look at all the the term sheets and some other materials with thorough explanations of each item of the term sheet. And if you're worried about liquidation or some other specific point, there are some quite good explanations. So, well, that's it for the introduction. Maybe I'd like to invite Padraig and Carmen to share the panel.
Okay. Hi. My name is Carmen Chen, founder of EPiC Ventures. So I was also an entrepreneur myself for 17 years before I started investment 4 years ago. And EPiC Ventures is a global VC firm. So we have invested in close to 40 companies across 10 countries. That's why we have seen many different kinds of term sheets. And today we try to share some of our observation and experience with you. And we also invite Patrick to join us so that Patrick can also share more context related to Hong Kong, because some of the common practice outside Hong Kong, like in US, sometimes when applied to Hong Kong, there may be some different situations. So Patrick may be able to share more about that perspective with us.
Oh, sure. Maybe Maybe I can start with a very broad question. What are the usual pitfalls that startups fall into when trying to start their fundraising of a seed?
Carmen asked if I wanted to start. Now let me think about that. I think the common pitfalls that I tend to come across is, what I always say to founders is that they should get their house in order before they approach any third party. Even at this stage you might well have burned family and friends, and now you're going on to other third parties. So be mindful of the questions they're likely to ask. Be aware of the types of things that they will be looking for from you, and be prepared to meet that full face and with confidence. So that might mean knowing what kinds of questions or inquiries that investors might ask in relation to what your business model is, what your background is, why you will be successful as opposed to all the other investment opportunities that might be out there. As a lawyer, I would say, do some basic things in respect of your housekeeping, just to make sure that you have something presentable when investors look to ask for or look at various things like what your cap table might look like, whether there's anyone else who might have interests over the equity in the company and so forth. And to have a look at your IP, to make sure that your IP is secured and properly housed within the business that you're presenting to the investor to invest into. I think these are the things you do before you even think about approaching an investor. And then when you're at that stage where you've done that kind of basic platform, I think the next important thing is to do some due diligence on your investors. Of course, Carmen would come up very shiny and bright in that. But you need to distinguish between the investors who are out there. Because there are investors who invest in companies at different stages in their growth cycle. And there's no point at a seed stage or as an early stage looking to approach investors who only invest a certain investment amount that's more suitable for a later stage company. So you've got to identify that. The second thing you've got to identify is that the investor that you're approaching or that you're in contact with has an interest in the business space that you're involved in. So if an investor is known for only investing, for instance, in, say, IoT hardware, and you're approaching them in relation to a social tech platform, that's not what they do. So they're not going to be interested. You're wasting your time, you're wasting their time. So and that kind of due diligence is quite easy, because most sophisticated venture investors, even seed investors, they'll have websites. And on their websites, they will have a section where you can click through and see their portfolio companies, the companies they've invested in the past. So it's not mysterious. It just takes a little bit of time and effort on your own part. And then you just go through the process with confidence from there. So I'll pass on to Carmen, because I think Carmen will be able also to share the things that an investor is looking for, even before, in you as a founder company, even before you get into talking terms in respect of a term sheet, which I think is a fascinating thing.
Okay, so yeah, actually I'm looking at, when I look at founders, I'm looking at something that they already prepared before coming to me. So it may be really before the investment term sheet. So some of the things that I hope founder get prepared would be, for example, like founder vesting plan. And the second thing is the option plan. So these two plans are very important. And sometimes when you have the founder vesting plan agreement with your own funding team, you can also add this into your term sheet. So these are very important. One of the reasons is emergent. I always talk about founder vesting plan actually is to protect the entrepreneur. Yeah, because some of the founder may feel like, some founder feel like founder vesting plan is not very good for themselves. Because I found this company, then why I cannot get all the shares now? Founder vesting plan is like you get the shares with a schedule across maybe 3 years or 4 years, right? So this is very important because emergent. If everybody can get all their shares in day one, what if one of your co-founder want to leave after 1 year? What would happen? So the share that he owned would become sleeping share. If he owned 25% of your company, then 25% would become sleeping share. That would be a very big discount for investor. Basically, it would be very difficult for you to raise future money if that's the case. That's why founder vesting plan is very important for the founding team so that you could keep most of the shares for the people who stay with the team. That's very important. And I have witnessed a lot of companies, because they have implemented the founder vesting plan, so when somebody in the team want to leave, they already know how to arrange it. So there is a good exit plan for the person who want to leave, and the people who stay got enough shares to continue to drive the incentive. That's why this is very important. And for the arrangement of founder vesting plan, you could just search internet, and you will be able to find the common practice. So I usually encourage using 4 years vesting instead of 3 years. Okay. Another thing is the option plan. So it's good that you have the option plan before you approach the investor. It looks more professional, actually. So you have founder vesting plan, option plan. For the option plan, usually the percentage is around 10 to 20%. Depends on how big your founding team is. If you are a single founder, you may have a bigger option plan, bigger option pool, so that you could later on recruit some founder level co-worker to help you. If you have a founding team of like 4 co-founders, maybe you can start with a 10%. Okay, so that's something you could think of before the term sheet.
Okay. So when would you say that, what are the best use cases? When should one use a convertible note? When should one use a SAFE or a normal equity seed round financing?
Maybe I start. Okay. So actually, it's pretty interesting. If you look at the equity round, or the convertible note round. So everybody know that equity round is more complicated, right? You need to pay much more legal fee to set up all the related agreements and documents, and you also need to have the different class of shares for investor and for founders. But one thing that I noticed from my own observation is the company structure. So nowadays, a lot of the startup, they may start with a certain company structure. For example, you start from Hong Kong, you have a Hong Kong limited company. So it's a Hong Kong limited company structure, okay? But a lot of the startup, when you scale up, when you expand to different countries, or you start to raise money from investor of different countries. So some of the startup will require a restructure in the company structure. So it's very common that in the Series A round, you will need a different company structure. In our case, some of our portfolio company, if they go to US to raise money from Silicon Valley investor, they need to restructure their company to a US Delaware parent structure. Some other company, they will use Cayman Island or BVI. So that means what you have done before with the Hong Kong limited structure is totally wasted. So all the different class of share that you set up, and all the shareholder agreement, everything, and the equity round, you need to do it once again. And you need to restructure the whole thing to your new parent structure. So that's my observation. That's why, personally, we are pretty open for a simple convertible note structure, so that you could start the fundraising, you could get the money much faster, and you could start to focus on your own business and leave the equity round later when you know what is your ultimate company structure. So for this part, maybe Patrick also got some experience and observation that he can share.
It's funny that way back when venture investing started, I mean, they came up with the notion of a Series A or an A investment round, and the idea was that that was your first formal, third-party professional investors. And then what happened was that investors identified that they could come in earlier than that, and that's when you got the seed round, seed investment round. And then things became more sophisticated again, where people realized that you could have intermediate financing between what would be your typical seed round and your Series A investment round. And you saw that there was this thing called a pre-Series A investment round. So when you hear these phrases, what I would say to you is don't get too hung up on what is an A round, what is a B round, what is a pre-Series A. Think of it more like first investment round, second investment round, third investment round. It happens that the numbers work out in a particular level in terms of the amounts that are typically raised in each of those, but it's an easier way to keep it in your head. Certainly when you get to a Series A stage, I would absolutely endorse what Carmen has said, which is that the structures tend to be just a little bit more complex. I mean, it gets even more complicated later, which is when it gets quite fun from a lawyer's perspective. But in the earlier stage, where it's a seed investment round, there may not be the driving need in order to have a complicated capital structure. It depends on what your investors are demanding. But what I think is true is that if it's a situation where you have investors who require particular rights that need to be put into separate share classes. So there'll be the share class that's there when you set up your company. That's the ordinary share class. That's what you as a business owner, as a founder will hold. But when investors come in, because they're giving you hard capital, money that you can use to operate in your business, they're going to say, well, that's got a price, so I'm going to want some particular rights, and they may ask for a special share class with special rights attached to it. Now, if you do that in a Hong Kong company, it's quite straightforward, but there might be a stage where you'll have to do that at a later stage if there's a restructure, and you will do it through whatever your holding company might be, which could be a BVI company, a Cayman company, a Delaware Corp, could be any number of species or stripes and colors. So there is this thing about trying to manage the cost and complexity of the process and tailor it to the amount that you're raising. And I think that's really where the difference between a convertible note or an equity round comes in. If you want something that is fairly straightforward and easy to complete, then you would look towards maybe doing a convertible note round. If it's something where you don't really even want to have any negotiation as such, but simply a simple, here's money and take your chances, you might get something out of it. That's where a SAFE comes in. Now, one thing I would say about a SAFE, which is really an instrument for very early stage investing, is that the documents you find on the internet, they are documents that are typically drafted according to California law. That doesn't necessarily translate 100% when you're using that document for a Hong Kong company. So there is a little bit extra that you need to do just to find out what are the changes you need to make to the document. There are not many changes, it's just a couple of changes, in order for that document to work in Hong Kong. So that's something to think about, but it's quite a straightforward process. Convertible note, there are a few extra provisions in there, but one thing that is different between, that is, if you look at the SAFE and the convertible note, and you compare those two species with an equity round, I think the one thing that you can say is that the investor rights that are in a convertible note or in a SAFE document are negligible. So your investors are really, they're taking a punt. And that's where the cap and the discount come in, because you know that is essentially the price the investor is charging for investing in you at a very early stage. So, you know, you think about those different factors. You've got a simplicity in the process, less cost in the process, meaning faster to raise. Fairly blunt instruments. The SAFE and the convertible note, because they're relatively standard and they're intended to be like a one-size-fits-all. Well, you know, one size never fits all. There's no such thing as an average transaction or an average person. So it's not going to cover all situations or all instances, and there's risk involved in that. But at the same time, it gets you where you need to be at an early stage in your development, and when you get to a stage where you need a bit more money because there's more going on in your business, you know, you've got your product market fit, you're ready to scale up, and at that point you need proper capital into the business, and you do need to do an equity round, and you've got enough traction in order to have a sensible valuation in terms of where your business is. When you've got all of those dynamics and features in place, that's the time when an equity round makes sense. Depending on the capital you need, you can call it seed, pre-series A investment round. Call it what you like. It's going to be your first formal investment round.
Maybe we can get into detail with certain features of the financing agreements, like the valuation, the cap, the discount, the maturity. How to determine this, and what is the standard?
So you have seen for convertible note, there are different versions, right? Some with valuation cap, some without, and the discount also. But in reality, most of the time, what I see is there will be a valuation cap, usually, and then there will be a discount. But usually the discount doesn't mean anything. That's the situation. The reason is, when you try to raise a convertible note without valuation cap, it's pretty difficult to close the round unless you have super attractive traction. But I haven't seen that kind of startup. But I have seen some, once a while, some startup have a convertible note without valuation cap. But 90% of the startup provide a valuation cap. And why I said usually the discount didn't mean anything in practice, because a lot of the time when the startup try to provide a valuation cap, they already plan to have that round of funding that's enough for them to go for, say, around 1 year or 18 months. So that means the next round would usually be after 1 year. And the valuation of the startup is supposed to be higher than the valuation cap. So that's why the valuation cap and the discount didn't mean much, because the discount only means something if your next round is lower than the valuation cap. Then the investor in this round will get a discount. But if the next round is higher than the valuation cap, then you wouldn't have any discount. So you will be capped. Your valuation will be capped in the valuation cap. So that's why in a market like the moment, most of the valuation is up round instead of a down round. The discount didn't mean much. Discount only means something when there is a down round. Okay? That means you raise in a valuation lower than the current valuation. So that's our observation.
Maybe just to rewind back and just explain what a discount and a cap is, so you can see the dynamics between them. What a discount is, it's a discount against the price per share in the next investment round. So say, for instance, you go out to raise your first formal investment round, and you've done a convertible loan note or a SAFE beforehand, and you've given a, say, 20% discount, which is roughly where the standard is. And here I'm going to go into numbers. Now, one thing I need to provide my disclaimer for: lawyers don't do maths. So if I get the maths wrong, that's because I'm a lawyer, so please forgive me. So say you go out and you achieve a price per share in your first formal investment round of $100, and you've got a 20% discount. That means that the amount that was contributed in the convertible loan note will convert at a rate of $80 per share, so 20% off the price per share that you're offering the other investors. So effectively, what the investor or the convertible loan note holder is getting is he's getting more shares per dollar in terms of his in terms of the ultimate transition from money to shares and to equity in the company. Now, a cap is slightly different. What it says is that if the valuation actually achieved in a first formal investment round or in an investment round is above the valuation cap on a pre-money basis. Pre-money means before the investor capital comes in. So if the valuation is actually above the valuation cap at a pre-money level, then the conversion will occur and convert as if the valuation cap applied rather than the higher actual valuation amount. And what you're doing with the valuation cap, the way to think about it is you are pricing the upside that you are giving to the investor. You're pricing the upside that you are giving to the convertible loan note holder or the SAFE holder. And when you're doing that, there's a kind of a science and an art to it. The science bit is that you are trying to pitch, as a founder, you're trying to pitch your valuation cap as high as is justifiable, because that's a way of protecting your own position. And at the same time, not so high that it is not attractive to people to give you the funding when you need it. There's an equal challenge where if you have your valuation cap too low, then you will hit that valuation cap very, very quickly, which means that you're giving the maximum amount of shares away that investor will see in terms of your priced upside. And that could, in some circumstances, make you less attractive to other investors. So you can see there are dynamics that are involved in that. You need to understand those dynamics. One of the things that I say to founders is the best way to understand the interplay between all of these is to model it out. Give yourself some scenarios with figures plugged in. Play it out in terms of what a cap table looks like and what the consequence is. And you'll see what the difference is. And you'll see whether you're happy with where you are, where the investors are, both in terms of the people you're providing the notes to and the prospective incoming investors coming in. And you can look at your, as Carmen said, you look at your valuation cap and you're trying to assess what the valuation of the company might be at the time when you're likely to raise another investment round. And that's how you're also trying to assess what the value would be. But the best advice is model it out. Do some scenarios, plug the numbers in, see what it looks like, because what you're dealing with here, and this is why it's fundamental, why it's absolutely critical for you, you are dealing with the shares and the equity that you ultimately will hold. That means this is the value you are ascribing to yourself for your blood, sweat, and tears in getting this business off the ground. So if you get these judgments wrong, you're probably selling yourself out short. And that's what you want to avoid. So it's worthwhile taking the time, the effort to find, the right resources to be able to do those models, get yourself comfortable with what the black and white outcomes are. Because you can speak about the theory, you really only understand it when you see it in the black and white.
So I think a lot of the founder will face a problem on the valuation. So how do I put the valuation, the pre-money valuation of my company? So the reality is, as Patrick also mentioned, the valuation cannot be too high, and actually it also cannot be too low. Investor, if you put your valuation too low, as an investor, they also worry, because you may have a too big dilution in a very early stage. So as an investor, we also don't want the startup's valuation is not reasonably, in a standard. Too low is also not good. I've seen some startup start with something like 100,000 US dollar, and then got diluted 10% with only 10K US dollar. So that's really too low. So basically, I just asked them to restructure. Luckily, that startup, the investor who gave them 10K is a friend. So they understand, I explained to them what would be the problem that they are facing, and they understand and they restructure, so that's a happy ending, okay? But the thing is, how do you know what is the standard? So to be honest, it's really case by case. It's very difficult to tell you what would be the range. But it's good to have a lead investor first, so that your lead investor could help to provide you some idea of the valuation that you could ask for in your with your traction, with your matrix. Okay, so always try to find the lead investor first before you go to other investor with a valuation. But if you didn't have the valuation yet, you could talk to different potential investors, ask for opinion before you set the price. That would be a good practice. Yeah.
So I'm going to say something that is maybe different from the investor perspective. I mean, personally, if I was in your boots, I wouldn't ask an investor, how much would you value me at? I would start first by, I mean, if you look around you at the moment, maybe there's 50 people here, that's like 50 sources of information. If you think of what the community spirit is amongst founders, or generally amongst the venture community, you will find that people aren't that shy about telling you what valuation they achieved and at what stage. So even if you're, of course, every founder has got a unique selling proposition. So I'm not saying that there are businesses that are exactly the same as you. There are businesses that are similar. And there are businesses that have gone through funding cycles before. And there are ways that you can get connected to those founders, to have conversations with them, to see how they went around the valuation propositions. So to take the mystery out of it in terms of what it is you need to do in order to have a justifiable valuation proposition. I think if you've done your homework that way, and then you build up reasons, some level of logic. I mean, at the early stages, I mean, it's really who the hell knows. But you try and find some reasons that you don't look too embarrassed by if you're challenged on it, because you will be challenged. And then I think you go out to friends or friendly investors who you may not necessarily be approaching for a specific investment. You're asking them for guidance. You know, this is what I've done in terms of my own research. This is what I think it is. These are the reasons why. Does that stack up? If you were investing in me, and by the way, I'm not ruling that out, but if you were investing in me, what kind of questions would you throw at me? What do you think isn't quite validated by what I've presented? And I think that's the pre-stage where you can just rely on your peers to give you a bit of insight and guidance.
So this is a question about the farther stage after the convertible note financing. Why do investors convert into preferred shares, and why are they motivated to convert those into common shares.
This must be a technical question. I got it first. So in terms of why investors want a different share class, so firstly, just to explain how this works in respect of the constitution of a company. As I mentioned before, when you set up a Hong Kong company or any private limited company, it comes with a single share class typically, the ordinary share class. One vote, one share, one vote, division of distribution of profits, dividends and so forth, according to the number of shares held on a pro rata basis, and pro rata participation in respect of insolvency. Now, when an investor comes in, remember they're a financial investor. They may be able to help you in different ways, but they're primarily a financial investor. So they're investing in you, not because they like you, even if they do like you, but because they're expecting a return on their investment. And when you're making any kind of an investment proposition in that context, you're trying to maximize your upside and minimize your downside. You're trying to deflect potential risk in terms of preserving the capital value of your investment and make sure that where possible you can get as much as possible in terms of the return on capital for what you've invested. And a lot of those, many of the rights that investors will look for to achieve that objective, they will only achieve that objective if they treat themselves differently from how they treat the holders of ordinary shares, the other people. I'm looking for something special. That means that I'm different from everybody else. And the way you achieve that within the constitution of a company is that you create separate share classes. So if you as a founder hold ordinary shares, you'll have traditional rights. But if you as an investor, you subscribe for preference shares or preferred shares, then you've got special rights. And those special rights have an economic value that is intended to protect downside and maximize upside. And that's why when you look at a term sheet, you will find that there'll be terms in provisions in a term sheet that will say things like, that there will be a liquidation or a liquidity preference, or that there will be certain rights in respect of anti-dilution protection. There'll be certain rights of appointment to the board, be certain rights about a follow-on right in terms of participating in future investment rounds. And these are all special rights that you can say only holders of the preferred shares have, or they have them first before the holders of ordinary shares can enjoy those rights. So you're separating out the upside and downside in respect of where the investors are and where the founders are. Now, I think the second question you asked was, why would a preferred shareholder be motivated to convert into ordinary shares? And that's a bit complicated. So let's take it through step by step. To understand that, you need to understand what is a liquidation preference. And let me give you a little bit of the history and background to that. So back in the early days of venture investing on the West Coast, the idea of the liquidation preference was to account for a situation where you invest in a startup. This is from an investor perspective. And the startup goes belly up, so it doesn't succeed. But there's something of value in there. So if it's wound up, there'll be something left in the pot to be distributed. And the idea behind the liquidation preference was to say that when that gets divided out, dividend up, distributed up to the shareholders, including the investors, well, the investors would get the first cut of what was there. And that would either be to whatever their invested capital amount was, or to a multiple of it. So it might be, capital, which is, your 1x plus some kind of participation right. Then, of course, investors being the canny creatures that they are, that was a downside protection if the investment failed. Then realize that the same concept could be applied to salvage value from the middling kind of investment. So if you think of when an investor makes an investment, three things typically happen. One, venture fails. That's like a good proportion of cases. There's a class of cases where it's not an outstanding success, which is, the minority. So there's second case, outstanding success. But there's another class of ventures where it's not an outstanding success, it's not a failure, it's kind of, in that middle bracket. So the venture investors looked at the liquidation preference and said, we can capture more value from those middling investments. Because they're not really returning proper investment if we simply stay with a simple, downside protection liquidation preference. So how can we do that? Well, they came up with this idea of what's called a liquidity event. So here, the company has not failed, so it's not entered liquidation, it's not insolvent. Instead, something else happens. There's a trade sale. Someone buys the business or buys the assets of the business. And that's the normal other liquidity event. There's an IPO also, but that's kind of fantasy land. So let's focus on the trade sale. So someone else either acquires the shares, buys the assets, or you do some kind of a merger or amalgamation of two businesses. And in that context, there's cash that's available that should be distributed up to the shareholders. And what the liquidation preference does is it carves up the pie in a way that is not necessarily one share, one vote. It is divided according to what the liquidation preference decides. So it could be where you say you've got a return of capital plus a participating return on an as-converted basis. And that would mean that your preferred shares there's a conversion ratio, and assuming there hasn't been any dilution event, you pretend that your preferred shares are ordinary shares, or actually convert them if that's required for the transaction. And you would have an enhanced recovery in terms of of the participating return that you have, according to an adjustment to that conversion ratio. And you can cap what that might be. So when you hear something that says, you've got a 1x preference with a 2x participation. And sometimes that's all that will be in your term sheet. This is one of the things about term sheets. It's coded language. You think of that. 1x cap, 2x participation. That sounds fairly innocuous. That means that the investor is getting their capital back plus multiply by 2 before the ordinary shareholders, the founders, before you get the opportunity to see any money. And that's quite a high bar. So if you don't understand what that phrase means, you're already behind the black ball. But what happens is that even if you've got, say, a 1x cap and a 2x participation, there will come a point in time where that 2x participation, the investor will receive more by converting to ordinary shares because the company is so successful than if they continue to hold preferred shares. And at that point in time, what you want to do as a founder is to make sure that that is as close as possible in terms of where that point of arrival might be. What the investor wants to do, if they've accepted the principle of a cap on their participation right, and they don't always do, but if they accept a principle of a cap on their participation right, they'll want it to be as far out as possible, because that means they're maximizing their value in that middling range of mid-performance investments that they've made. If it's an outstanding success, investors will just convert to ordinary, assuming that there's a cap on their participation right. Sorry, I was a bit long-winded, but there's a lot to get through, so.
Yeah, maybe I can add a little bit more on the liquidation preference. So I found that in the market, in different regions, there's different liquidation preference standard. So like in US or Hong Kong, it's pretty different from China and even Japan. That's what I heard. So I have heard the most founder-friendly liquidation preference is 1x. So investor just recover what they invested. Okay, so that's a very founder-friendly terms. I've heard that in Japan, the norm is 2x. So investor get 2x their investment. In China, somebody said the normal practice is 1.5x. So maybe Patrick can share a little bit more.
Funny, actually, we have some, well, it's a little bit outdated, but it's still Hong Kong intelligence on this. About a year and a half ago, we did an exercise with some investors in town. And what we did was we created an investment term sheet for a seed stage investment. And we went out to a range of investors and asked them, if this investment term sheet was presented to you, would you consider it as being market standard? So we had kind of 3 questions for them. One was, or 3 standards. One was, is there anything in here that is so outrageous it really shouldn't be in here? It's not market. Then we had something which was, you see it in the market, but it's not exactly what you would do. And then there was, yeah, this is standard, we would accept this if given. So there was those kind of levels when we were doing the analysis. The stuff that was wildly off beam, we just took it out of the investment term sheet altogether. The stuff that was, yeah, sometimes we see it, sometimes we don't, we put square brackets around it. And the things that was accepted as market standard, we left as plain text. When it came to the liquidation preference, a difference was drawn between seed and pre-series A. So in Hong Kong, for seed, it was 1x. For pre-series A, it was 1x plus a 1x participating cap. So it's 1 plus 1. But there were views, there was no real standard as such. I remember having a conversation with one of the investors we spoke to, and he was passionate about the fact that if you are an early investor, you should not be protecting your downside. Now, he was the kind of investor you would want to speak to. But that was not the prevailing view, but you could see that that was a unique perspective coming from where he viewed his investment philosophy. So I think, you know roughly where the market is, but these are things you negotiate. I think if you see something that says, for an early investment, and it says a 1x cap. Basically, you get your capital back if things go awry. You shouldn't bother negotiating that. That's fair. That's very fair on both sides. If you see things that go beyond that, that's where you kind of have a cold hard look at it and you start negotiating.
By the way, for Click Ventures, usually we do 1x only.